Welcome to the Change Exchange, where we are helping you find ways to make the most out of your paycheck. Here's a scary thought. If you are 25 years old today, you have a good statistical chance of living to the age of 90, okay? So if you plan on retiring at the age of 60, that means you only have 420 paychecks before retirement, at which point you will need to have sufficient money to fund 360 months of expenses. There are only 3 ways that you're going to achieve this. Start saving today, invest in growth assets that will grow ahead of inflation, like property and shares, and reinvent your career so that you can earn an income well into your 60s. So let's start with the savings part. The good news is that you have the opportunity to save money you would normally have handed over to the taxman by investing in a retirement fund. Depending on your tax rate, you're able to save between 18 to 40% more each month. If your marginal tax rate is 30%, for every 1,000 Rand you invest, you pay 300 Rand less tax. That is an extra 300 Rand to put into your retirement savings each month, or 126,000 over your working life. Now take the growth on that saving. If you invested this tax saving of 300 Rand into a growth fund earning 12% a year, over 35 years you would have accumulated nearly 2 million thanks to the taxman. Not only do you receive a tax break when you invest, but you also don't pay capital gains tax, dividend tax, or interest income tax. Over a period of 35 years, these tax savings can effectively double your lump sum in retirement, compared to a saving outside of a retirement fund structure, such as a unit trust. A retirement fund is also safe from creditors. So if you hit financial difficulty, no one can attach your retirement funds, not even SARS. It is one of the few financial protections you have. Unfortunately, government does limit the amount you can save tax-free. Currently, the amount that you can put away is around 15% of your salary. But these figures are being revised, and we expect in 2016 to be able to save up to 27% of our salary tax-free. When it comes to selecting the right retirement product, the most cost-effective way is to invest through your company's retirement fund. If, however, you're self-employed, your company does not have a retirement fund, or you cannot maximize your retirement savings through the company fund, you should then invest in a retirement annuity. It's worth explaining the difference between an employer fund and a retirement annuity. A retirement annuity is a retirement fund taken out by an individual, and it is not affected when you change jobs. The only thing is you can't cash the money in until you reach retirement age. On the other hand, a pension fund or provident fund is provided by the employer to the employee. Should you leave your employer, you can either withdraw these funds as cash or preserve them. If you decide to cash in your funds, taxation will apply, and you will lose your tax-free benefit withdrawal on retirement. If you do choose to preserve the funds, you could arrange to have the funds transferred to your new employer's fund, to a preservation fund, or a retirement annuity. Not only is it a good idea to preserve your funds so that you have sufficient money in retirement, but you also avoid taxation.